All right, welcome everybody to another Okie Trade study session. Well, it's been a while, I guess like over a year, but I started a Discord where you could pay to get in, and basically that was because I was putting in that real deal work, studying my butt off every single day, tracking everything, and if you wanted to see that, like behind the scenes action, well, it was going to cost you. And there was like 10, 12 people in there, and I'll get to the reason why I'm bringing this up, but it dwindled down, and that's because the market was slow to start off the year, January, February, March. And I just want to point out that those are the times when you need to study up, especially and your old setups that you're trying to master, for one, because it's better to master one setup than, you know, learn little on a lot of them. I'll say that to start off with. But then two, in the slow times, you do learn setups, but you need to start off with mastering your own, but learn new setups as well, ones that you are seeing working. But by the time you understand how it works, obviously it's going to go away pretty much most of the time, unless you find that very rare pattern that sticks around. And we're going to talk about a very rare pattern that basically happens at all times of the year. But I will give the caveat that in the winter months, you can basically count on this pattern to be working at its best. And what I mean by that is you're going to have a lot of opportunities. So I will say that in a slow market, most of the year, um, you're going to see, like maybe three, four of these multi-day breakouts per month, per variation. So, sometimes you'll see two of each variation and you get like 8 trades a month, and sometimes you only see one of each variation and you get 4 trades a month, something like that. But in a slow market, you'll basically, everybody's going to be looking at that stock because that's the stock that's running. So you basically kind of have to have your wider risks, and because it's going to just be really choppy, everybody's going to be getting in and out, in and out, in and out, whatever, right? And you have to have your wider risk, and you scale out to the target. So you have to go big, but in a really slow market, that's kind of what I like about a slow market, is that it helps you to push size because you have to push size because the opportunities are way less, but it teaches you to respect your stops. And that's something we're going to also get into, because something that is a game changer for me is that you also have to realize that in a hot market, you don't really need stops. And we'll get into that. But to go back, you kind of have your stops, you know your target, and you respect. Maybe you get an ad or two, but usually, since everybody's trading it, it's going to explode and you're not going to really find a good ad after your first entry. So that's why you have to take pretty big size, and it's good to help you push that size and kind of get that mental stress, out of the way, so that when the hot market does come up, you'll be able to push that big size, and there's a lot more opportunities. But I want to get into how we change the way we trade it. So it's pretty easy to understand that you have a wide stop, whatever your entry might be, you have a target and you scale out into strength all the way up to that target. That's basically how you're going to trade these multi-day breakouts in a slow market. But what I want to do today is really go over a couple of key psychological mind shifts, because in a hot market, there's way more plays. But what does that mean? That means that the money flow is more spread out. There's a lot more setups that are happening. And what does that mean? To me, that means that your setups are going to work less often. So you're going to have more opportunities, but the win rate's going to go down. And I think where people really mess up is they're trading more than one setup, right? And so they don't understand the fact that whenever the market heats up, you have to change the way you structure your size, or for sure size down, knowing that you have a lower win rate. But what I want to do is figure out how to keep a high win rate and also have big size and take advantage of every opportunity versus, really in a hot market, if you take wide stops, it's on this setup. That's another thing I want to really key in on here is that you can't take every way that you structure how you trade to every setup. Like some setups, like you have to have your wider stops no matter what. Or, some setups you would love to have a wider stop, but you really need your tighter stops. Um, so it just depends. And it could be time related stops, um, EMA, anything like that. So you have to look at your own setups and understand them. And then you also have to understand how they operate in different environments. But it's good to have like a money management structure that keeps you from having to guess what to do when you're under fire. And in the hot market, you're going to have more opportunities and everything's moving very fast. You need to know exactly what to do in live time, right? There should be no guesswork. So, a couple of things that I want to talk about, and it completely changed the game for me. And I made a ton of money in like 2 weeks with that game changer idea. And then it basically the whole market slowed down with Trump's talk about tariffs. And but the reason why I'm doing this video and why I'm not just doing this for, because I have a lot of private videos that I upload on my YouTube, but only the people in my Discord have the link to them. Um, so, but I'm going to upload this for everybody else to see because, not only is it Christmas time and all that, but something very special could be happening. And I think it is based on how the president put it. So we'll see here. Trump announces $2,000 tariff dividend for America. He said, like, it is happening. He didn't put a date on it, but he did say it is he didn't say if or maybe. It was like this is happening. And then PDT, the pattern day trader rule, which, keeps people in a margin account from trading less than 3 times, or yeah, more, it keeps them from trading more than 3 times in a rolling 5-day period, now gets dropped to $2,000. So it's no coincidence, right, that we're all going to get 2,000 bucks and PDT is getting dropped to 2,000. So everybody's going to be able to short stocks. That's the thing. It's more about shorting. And because, I mean, you could get a cash account and then you could trade your full account once per day and you get it back. But the difference with the margin account is you could trade your full account 100 times in the same day and it just keeps replenishing. But I also think what it's going to do is going to allow people to short in these stocks on these easy to borrow, especially. They're going to go crazy, like, because all these new traders, they're going to just be shorting stocks when they shouldn't be. Like, and that's why I want to put this pattern out for y'all because it's a really good pattern and it happens a lot, especially in a hot market. I mean, you're going to see it happen in like 10 to 15 times. And I'm going to go over one variation in depth. And that's because that one variation can be basically, you can use the structure that I'm going to teach you to trade all the variations. And I'll kind of go over quickly the variations. But you'll want to hop in my Discord if you want to get the watch list that I post every single night. And I'm going to talk about the personalities of the stocks so that you know how to trade them because that's another structure that I'll be implementing. So now that we understand that the market's about to go crazy, and I think it's going to go crazy just on the thought of it as well. So, and then when it actually happens, like, yeah, it's going to go nuts. And then based on the time of year that it is. So, what I want to do is let's go into a breakout, the multi-day breakout. So what we have is the multi-day breakout, and obviously, if you don't know the setup, you can go back over my channel. There's a lot of info on it, but I'll go over it quickly. And it's a stock that basically doesn't have much of a history. I mean, it can have a history, just no volume compared to the relative action or relative volume to the action that's happening right now. So we have a stock, right? Nothing's really happening volume wise. Then it gaps up, doesn't have to gap up, but this one gaps up and makes a big move. So that's the key, a big move on high relative volume. And then it holds up, gives you that look like, hey man, it's about to break out over this high. Now they don't always break out as you see. This one kind of like held halfway up, opens here at 7, gets all the way up to that breakout level, and then fails. And I want to teach how I'm taking advantage of being able to capture the full move, and if the stock fails, I'm making money on the, um, I guess you could call it scalp side of it as well. So a couple of things. Um, and this is just basically the third day surge with a multi-day breakout variation. So on this V wave, VWAV, whatever you want to call it, we're looking at this day right here. And we have the previous close, right? So it gaps above the previous close, cools down, and then it has the breakout. And it fails, right? So what I want to talk about is how I'm structuring these setups. And I'll give a quick overview of how I did it in a slow market, and it's just the way you have to do it. Now, in a slow market, the high of day versus low of day is kind of the way you have to do it. But I will say that they're going to be a lot tighter than this. If you notice, like, all right, 937 is high of day, and then low of day is down here at, roughly around 837. So a full dollar of share, but in a slow market, it's going to probably be like 9 is high of day, and then 860 is low of day. So you'll have like a 40-cent stop versus a $1 stop. Anyways, this is the key aspect. I want to basically risk break even, and I want to find the tight risk reward entries. Now, these multi-day breakouts, they always have the same type of entries, which are, if you have a pullback, the first 1 minute candle to make a new high is a type of entry. Um, the higher the volume, the better that's going to work. The lower the volume, the more trickier they are. And let's just say, golly, who's this guy riding this? You can't even call it a motorcycle around my neighborhood. It's more like a weed eater. I don't know if you can hear it, but it's pretty loud. Um, you get the candle to make a first minute new high, right? So you buy right here, comes up, stuffs. This is and so I want to point out that when I'm buying these stocks right now in a hot market, I want to risk break even. I don't want to have a stop, but we're going to be taking smaller size than normal. I'm going to show you how we figure out the size, but I want to go over a quick few aspects first so that you can understand why we have to take the size that we do. So, and I'm going over because people say, oh, when you risk break even, you're going to lose a lot more, and you're going to lose on the full stop, you know, too, right? And I'm like, yeah, but you're going to see how on when you have stock selection, good stock selection, that you're not going to get stopped out very often, and these specific key entries work out more often than not. Um, and I'm starting off with an example that is a little bit tough and tricky to start off with, so that you can understand how um, you can navigate the muddy water, so to speak, and then also notice how it works and then fails in the end anyways. And I want to show you how, um, basically the toughest, worst example almost. And then it only gets better from here. And I want to show you how to navigate, because if you can navigate this one, you're going to dominate the rest. So just bear with me right now. We buy here. This is one of the key entries. After the first pullback of the day, under first high of day, we're looking for the first 1 minute candle to make a new high. It fails instantly, right? There was no spike for us to sell half on, because that's what I want to do. I want to sell half into the first stall and then move my stop to break even. But in this case, right, it just instantly failed. So obviously your stop would be down here. So when it instantly fails, what do I do? Do I just cut right here? No. What I would do is, in this 1 minute candle, let's just say it pulls to like right here, holds and starts to spike up to where I bought it, but then can't break where I would buy it and starts to turn back down, I'm gonna cut right there. But in this case, it just instantly pulls hard, right, all the way down to where my stop would have to be. If it goes under there, I'm just having a cut, and it's gonna be a tough loss. But that's rarely gonna happen on this setup. It holds. I would add right here, and then when it spikes back up to my entry, I'm cutting this one on, because I have my lot set up on first in, first out. So when it spikes back up, I'm cutting this one, because look, it breaks through. I'm not just cutting it as it breaks through, but as it breaks through and starts to pull back under my entry, I'm cutting that one for break even. And this one, I'm selling half right here for small scalp. And then I'm moving the rest of the half of the entry to my entry, which would be right here above this 1 minute candle's high, right? So then I stop out the other half, break even. But look what happens. It holds. I'm not going to buy here, because this is just one of those examples where I'm like, okay, now it's kind of faking out on these. Let me see something more clear. It spikes. If it would have just went straight through high day, maybe I miss it, but what it does is it spikes, pulls, does it kind of what I expected, and they're fake out. But this time, holds and kind of gives this clean bar, right? And now look, I can draw a line from here to over here. It pulls. We're kind of making a higher low from here to here. This would be the other type of entry that I would take, would be the first wedge entry. And so when we get this wedge, a lot of places you can buy it. You can buy it over this red candle's high. The more safe entry would be over this candle's high. And the safest entry, but you start to lose a bit of risk reward, is over here, and especially over this one. But notice how it just shoots straight up. So this is where I want to get to, right? So I buy it as it breaks this candle. It instantly stuffs, but look what happens. It holds a little tiny dip, pushes through. Now, if it were to roll back through, I would just cut break even. But what does it do? It shoots straight through high of day. Normally I would buy a high of day, but with this wide of high of day, I'm just not doing it. And pretty much I'm also making this rule that I think I'm going to implement. I just started today, that if I'm buying underneath high of day, that means it wasn't really wide or tight enough to buy. So what I'm going to do is I'm not going to buy high of day. What I might do instead is just wait and buy the next dip. So, but I'm getting ahead of myself here. I buy here, right? It like instantly stuffs, and that's the only time I'm really going to hold. It shoots straight up through high day, stalls. I'm selling half right there. Now I can put my stop down here, risk half, and it's a risk-free trade, right? But then it dips under first high day. And now what I'm thinking I'm going to do, as it pulls through and starts to hold, I'm going to buy right here. Hold up. Give me a second, guys. I'll be right back. All right, I'm back. Sorry about that. Um, so where was I? So I've sold half here, right? So basically right here, we've got a break-even trade where it didn't work. We sold it into that. Then we had a little sale here for a half a scalp, cut the rest break even, so we're up a little bit of money. We've added, sold half. Now we've had a pretty solid trade on a stock that's just getting started. We sold half, right? Pulls, maybe we add some because it's the first hive day. It pulls and it begins to hold and turn. We add, shoot straight up, right? Stalls out. You sell half. So now you've got half from here. You've got half from here. And your stop would just be like right here where your entry was. It pulls. And what does it do? It creates a new wedge. So I'm personally going to buy that because it's really tied around first hive day. So you buy and look what happens. It just shoots straight up. Never test your entry. So that's why I'm saying, like in this market, you're going to get a win really quickly. And look what happened. This thing just went from 850 basically to 10.25. So almost $2 a share. So you buy half, right? You buy again, shoots up, you sell half. Obviously, you're moving your stop to break even right here. Holds, spikes back up, and then when you get that lower low right here, you can choose to cut, or you're just gonna stop out break even, and then the other one comes down here and you stop out the rest break even. But when one works, you're gonna get all of the entries, and they're gonna just keep going, and you're gonna get a huge trade. Okay, so now you might say to yourself, well, you're selling half, you're only getting half your shares to the target, and then you only got these scalps, and then it stopped out. Why not just sell all of it here, all of it here? Okay, good question. So what I'm doing is I'm actually buying double size. And you're saying, whoa, double size, like you're gonna get smoked. You're right. If I'm taking double max size. But what I want you to understand is now here comes the game changer perspective that I needed to break down for you. So we have to go back to the daily chart. We know that this stock can run from 4, we'll just say 12. So that's $8 a share. So instead of asking how much do we want to risk, we need to ask ourselves, how much do we want to make? So this stock can run from 4 to 12, so that's $8 a share. We want to make, let's just say we want to make $1,000. We know it can go $8 a share. So we would do 1,000 divided by 8. We need to have 125 shares. Okay, in this system, there's going to be about 4 specific setups, we'll just say, that you could have, right? Four, four specific entries that you could take. So if you would just do 125 divided by 4, you would be wanting to buy 31 shares per entry. You say, dang, that's small size. And I'm saying, you're right, but we're doubling up. So now 31. So you're taking 31 times 2, so you're getting 62.5 entries. Still a small size, right? Okay, so let's just go over this example here real quick. So 62 shares at 875, and you're selling 32 at 950, right? So what is that? 50 cents and 25 cents. So 75 cents. So you made like close to like $30, okay? But you still got your full shares of 35 shares, right? And then you've got 35 shares here, 35 shares here. So now you've got 65 shares. And then you added another 35. So that makes you to like 95. You're almost getting to your full size. Now you're at a full size and you sold another, like, so you've locked in basically. And what is this? All right. So on this one, you maybe lock in 10. This one, you lock in, like, let's just say 20. So there's $30 that you've locked in. And then on this one, you've locked in another 30. So that's $60 that you've locked in, and you've got full size so that if it goes to the target, right, which is what? $8 from low a day, 8 plus 8 is 16, you would make your $1,000. So in this case, but it stops out, right? And you don't just lose. You can move all your stops up, and then all these would be winners, or you can just keep moving your stops to your break even entries to see if it's going to turn back around, right? And in this example, like, because it failed, you didn't make much money. But most of the time, these are going to work. And when they do, you're going to make a lot of money. So you're going to be able to get your scalp when they fail. So on this example, you made like $70. Who cares? But when it would have worked, you would have made close to, 1,000. You would have made 1,000, maybe even more, because maybe when it shoots up and gets this tight risk to reward right here, instead of just adding 62 shares because it's 950 versus 940, really, maybe you add and you're up like $70 right here. You say, I want to risk 70, so I'm gonna take 500 shares right there, and then boom, you get all this extra size with break even risk. So that's kind of the game changer idea. And there's going to be times where it actually works out completely. But I wanted to make sure that you understood that you can make money, and maybe it's small money for when they don't work out, right? But I want to show you a good example for when it does really quick, um, and some of the entries that I might trade on it. So this star one, here we go. Okay, so we know that this stock can run from, let's just say 150 to 4, so 150, 250, 350, $2.50 a share. And then on this day, where does it go? It goes $4 a share. So it went even higher than what we could have expected. All right. So we'll just say that $2.50, we want to make, now that we've made 1,000, we made a couple of wins, we want to make it 5,000. Right. So we divide that by 4. So we need 1,250 per share times 2. So that's 2,500 we go per share. So on this one right here, on the very first entry, it's 4. So one of the entries that I like, so look, if you notice it gaps up just above the previous close, I like to buy the first 1 minute candle to make a new high on stocks that specifically have the personality of one that can just shoot straight up. And this one did. So at the open, in 1 minute, all it could do was go between a channel of 498 versus 496. So a 2-cent stop. You could easily put a buy stop order at 499, and then once it triggers you in, you know, so what is that? 96. You would only lose $50 with double size right there. Or if you got some slippage, maybe you lose $100, 200. Who cares, right? But look, it shoots straight up from 5 to 575 and halts. Right out of the halt, I'm selling half. So what's half of 2,500 shares at well, we'll say 50 cents is what you get. So 1,200 shares, 1,250 times 0.5, 600, you just made $625 right there. And you only got 1/4 the size, right? Because you want to buy 4 times. So you sold half and you're risking break even. So your stop would be 4. Because look, yeah, this is something else you need to understand. If your entry is 498, that's the perfect entry. You get filled 498. So now your stop must be 497. You may have gotten filled at 503, but your stop needs to be 497. It pulls under 497, you stop out, break even, but you just made 600, right? but it instantly holds, reclaims. I'm taking that first 1 minute candle to make a new high. Spikes up, stall, sell half. I'm putting my stop at break even. It pulls under, so you stop out. But look, it instantly holds, starts to create this wedge. I buy back in. I get 1/4 my size. Boom. But I got double the shares. It spikes up, but it didn't really spike that far. So I'm probably not going to sell my half. And then it pulls, but it holds our entry. Is there a better chart here? No. It pulls, but it holds our entry. Doesn't go under the perfect entry. Notice that. And then it comes back through the other wedge. I'm buying again. And this time it stalls, so we don't get to sell half, but we've got double. So now we've got 5,000 shares. And we get that spike up, but it doesn't, if you're not quick, you don't get to sell half. And then it pulls, but our entry is right here. Look, it never goes under our entry. So we don't sell anything. And then this time when it spikes back up through that level we missed and it starts to stall, you sell half your share. So you sell 2,500 shares. And your average would have been, so if you bought right here 515, and then up here we'll just say 524, so that gives you an average of 520, and then we're selling half at roughly, we'll say 540. So we get 20 cents times 2,500 shares, 500. So we've already made 600. So 500, we made 1,100, and we've got 2,500 shares. When it comes up through high day, you can add 2,500 more shares, and look what happens. It breaks and never goes under the high of day. When it goes up through, especially on these wider ones, if you're buying and it starts to go back under, you just have to cut. But look, it holds above high day and takes off. So I'm just gonna we can pretend like we didn't take that because it is a bit wide, but we'll just say you have your 2,500 shares right here. Our target is right here. We don't sell. We've already made 1,100. 2,500 shares and it gets to 7. That's where we sell. So 5, average, 6, 7. We just made $5,000 with only half of the size. Plus, if it would have failed, we locked in $1,100. So we add 1,100 plus our 5,000, and we got 6,600. So that's a way that you can take your break-even trades, make a lot if they fail, and then when they work out, you get to get full size all the way to the target. And again, you say, well, you could get stopped out a bunch. Well, these setups, this specific setup, you're not going to get stopped out that lot. You're going to get a victory before you get stopped out most times if you're buying the right spots. Um, so I just wanted everybody to understand that little bit of a mind shift that I have taken versus taking the wide entry, wide stop. I'm getting tight risk to reward, stopping out break even, selling half. I'm doubling my size, selling half into the stall, looking to add, and then I get my shares to my target. So you just kind of have to trust it, start off smaller, and again, $1,000. You're like, that's a big gain, right? But 1,000, when it fails, you're only going to lose $60, $50, or if you even have max slippage, $100. But if it works, you're going to make $1,000. Or if it fails, you might make $70, $100, or lose 100, whatever. You don't need to be risking $1,000, $100 to make 5,000 by building in this way. All right, everybody. Hope you enjoyed the study session. All right. Peace.